Picture a person telling retirement plan participants, don't worry, your money is in a safe, short-term cash equivalent, while the real story is unfolding somewhere else entirely. Now, zoom in on the numbers the tax court had to stare down. It starts with roughly $2,032,000 taken from one plan, then grows into about $5,308,000 taken across two plans. It stretches from January 2010 until 2011 when the transfers were discovered. The jump is approximately $3,276,000 more, and the court ultimately treated about $5,308,000 as taxable embezzlement income. And that's the label that hangs over the whole thing, the retirement plan investment story that the court didn't buy. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. And if you like this tax court story breakdowns, please like this video and subscribe to this channel. This channel reviews and analyzes U.S. tax court cases to understand how U.S. tax law works. In this video, we cover the tax court decision in the case of Matthew Hutcheson and Annette Hutcheson versus Commissioner of Internal Revenue, decided on January 2nd, 2025. The opinion opens by putting the main characters in a very specific role. During 2010, the taxpayers were a trustee and fiduciary of two retirement plans, and the court says he diverted about $5,308,000 from them for personal benefit. One plan's money, the court says, went mainly towards personal expenses, most memorably buying and extensively renovating a new home. The other plan's money, the court says, went into an effort to acquire a resort and golf course. By 2011, the transfers were discovered. Ultimately, he was convicted of wire fraud and sentenced to more than 17 years in prison. And a criminal restitution order matched the same roughly $5,308,000 figure the tax court is dealing with on the tax side. Now let's rewind to the lifestyle setup the court lays out, because the tax court tells this story like a chain reaction. In 2009, the couple moved to Idaho and bought a farmhouse on 5 acres for approximately $700,000, a major upgrade from their prior home, which they sold for approximately $350,000. Then comes a private loan in early December 2009 of roughly $233,000. They used about $175,000 of that toward the home purchase and used the rest for personal expenses and professional expenses. The punchline is the loan terms. It had to be fully repaid by January 17, 2010. And the opinion describes an interest rate escalation that effectively worked out to roughly 120% per year if it wasn't repaid. The court states bluntly that the lack of funds to repay the loan by the due date precipitated the first transfer from retirement plan assets. And then the renovation story starts rolling. In February 2010, they hired a construction company to extensively renovate the new home. The opinion lists the upgrades in detail: garage conversion, bedroom remodels, and new bathroom, extensive cabinetry, a covered patio with an outdoor barbecue and kitchenette, a pool, a hot tub with a mechanical building, driveways, fencing, landscaping, demolition of an existing barn, construction of a new 2-story barn with living quarters, and even a horse riding arena. The work kept going until April 2011, when the contractor stopped because it wasn't being paid. The taxpayer wasn't, in court telling, a naive person wandering into fiduciary responsibility by accident. The opinion says he began working as an independent fiduciary in 1994, had formal education in financial services, pursued but didn't complete a doctorate, held multiple accreditations and certifications related to fiduciary responsibilities, and retirement plans, hosted symposiums, published articles, spoke frequently, and even testified before Congress about qualified plans and fiduciary obligations. In other words, the court paints someone who knew exactly what a fiduciary was supposed to do when it compares that to what happened next. The plan in question were multiple employer retirement plans used by small employers. The trustee was supposed to safeguard plan assets and invest them according to the governing trust agreement. The record keeper, a company the opinion describes as maintaining financial records and preparing participant statement, becomes a key character in the mechanics of the transfers. So does the concept of outside investment versus inside investments. In plain English, if assets are held by the custodian, the records keeper has visibility. If they're moved to an outside investment, the records keeper loses day-to-day visibility. The court's narrative makes it clear why that distinction mattered. Here's how the first plan's money moved. In January 2010, the trustee directed a transfer of approximately $233,000 from the plan's custodian account to another retirement plan's custodial account, and the money was used to repay that private loan. After an attempted second transfer ran into problems, the remaining transfers went to a bank account with a different name. An account, the opinion says, he had signatory authority over, and that the plan no longer used. The opinion notes that throughout 2010, the only deposits into that account were the retirement plan transfers. Total diverted from that first plan during 2010 was about $2,032,000. The records keeper wasn't just told move money. The court says the trustee instructed the records keeper which participants' accounts to liquidate, set the amount, and told the records keeper to record that participants were invested in something labeled like midterm interest-bearing cash equivalent at a major brokerage. He sold it as safe, collateralized, and producing about 14% return. He also gave participants messaging that the shift was about avoiding market volatility for a short period. Later, he continued to describe future transfers the same way: defensive posture, older participant base, short-term safety, while, as the court puts it, he kept making transfers whenever he needed more personal cash. By late December 2010, the opinion says he instructed liquidation of the plan's remaining inside investments and transferred the funds out. So where did that money go? The court states the couple used at least about $1,200,000 to purchase and renovate their Idaho home, including roughly $892,000 paid directly to the contractor from that bank account, plus amounts used to repay 2 private loans tied to purchase and renovation costs. The court emphasizes timing. Payments to the contractor typically happen the same day as or within about a week of money leaving the plan. When discovery started closing in during early 2011, they stopped paying the contractor in February 2011, although work continued until April 2011. The opinion then piles on examples of personal spending using plan assets. Approximately $93,000 for 3 cars, including one typically driven by a relative. Approximately $24,000 for holiday gifts that included a tractor and a down payment on all-terrain vehicles for children. Around $12,000 for furniture and another $12,000 for fencing, and roughly $16,000 in warehouse store purchases. It also mentions around $48,000 paid to the U.S. Department of the Treasury and another $10,000 in ATM withdrawals. On the professional and resort-related side, the opinion describes payments around $45,000 to a consulting firm involved in the resort pursuit, plus attorney fees and various professional expenses. Then the second plan story begins, and it's the resort and golf course thread. In August 2010, the trustee formed a company to purchase a resort that was in bankruptcy and an adjacent golf course that wasn't part of the bankruptcy. A contractor and the contractor's son were brought in as members, and the opinion says the couple led the contractor to believe they had the resources to buy the resort, backed by falsified financial statements showing net worth of roughly $400 million. Membership and the entity shifted on paper during the late 2010. By the end, the opinion says the couple owned 51% and the contractor family owned 49%, with the contractor family contributing no money and the trustee making all financial decisions. The acquisition strategy described in the opinion was two-part: become the stalking horse bidder for the resort in bankruptcy and separately purchase a bank note collateralized by the golf course. The company made an all-cash offer on roughly $40 million with the required escrow deposit of approximately $250,000 within 3 days of acceptance. The trustee also tried to push the second plan into buying the golf course collateralized note as a short-term investment, promising approximately 13 to 14% return in weeks. The plan's investment advisor refused, saying due diligence couldn't be done. The refusal didn't stop the money from moving. The opinion says the trustee directed liquidation of approximately $3,100,000 of the second plan's assets and then directed two transfers totaling approximately $3,276,000, while telling the records keeper to credit participants with a new outside fixed income investment tied to the bank. In reality, the court describes the first transfer, roughly $275,000, as feeding the escrow deposit mechanics, money that then gets moved into the acquisition entity account and onto an escrow account. When the bankruptcy case was dismissed in January 2011, the opinion says most of that escrow money, about $245,000 total, was pulled back and used for payroll, attorney fees, insurance, consulting, and even another car. The second transfer on December 27, 2010 was about $3 million into an escrow account for the purchase of banknote, which the escrow agent then used to pay the bank, recording the acquisition entity as the note's owner. And then comes a side plot that reads like a proof of funds fever dream. The opinion says the acquisition entity needed proof it could fund approximately $40 million purchase. A major custodian refused to provide a letter. The trustee then created a falsified proof of fund letter dated November 16, 2010, using falsified letterhead and an unauthorized electronic signature with incorrect branding details. After that, he got another proof of funds letter from a separate investment advisory firm's owner stating that funds existed and could be transferred, even though the opinion notes no accounts existed there for the trustee, the entity, or the plans. By early 2011, people around both plans started asking the obvious question: where is the money and why can't distributions be paid? The opinion describes plan participants seeing year-end statements listing outside investments, asking why they missed distributions, and realizing they didn't benefit from the stock market's run-up because their money had been pulled out. It describes the trustee repeatedly promising liquidation dates and kept passing, giving shifting explanations, market turbulence, custodian changes, communication failures, liquidity, and more. Eventually, an executive associated with the first plan contacted the custodian and learned it wasn't holding any assets. Pressure kept building. Reports were made to the Department of Labor in late summer 2011. The opinion says the trustee confessed to the executive that the plan assets were gone and couldn't be recovered. Though he still didn't confess the money had been used for the home renovation and personal spending. Even after that, the opinion says he continued to mislead participants for months. On the second plan side, the opinion describes the business partner and the investment advisor learning about the supposed outside investment in early 2011, being told it would liquidate in about 2 weeks with roughly 14% return, and then watching excuse after excuse. An ERISA audit demanded documentation. The trustee didn't provide it. In late March 2011, the opinion says the couple used the banknote as collateral for a private loan of approximately $425,000, signed individually and on behalf of the acquisition entity. Then defaulted, and the lender retained the note and recorded an assignment. A portion of those loan proceeds, about $122,000, was sent back to the first plan's account so distributions could be made, with the opinion describing efforts to conceal the true source of the acquisition entity's connection. Against that factual mountain, the tax court's legal conclusion is straightforward. Misappropriated funds used for personal benefit are gross income, and that includes an ERISA trustee who abandons the fiduciary role and treats plan assets as his own. The court holds the couple had taxable embezzlement income of approximately $5,308,000 for year 2010, plus roughly $11,000 of other unreported income. It also holds they owe an additional 10% tax on early distribution from an individual retirement account described in the opinion as approximately $4,000 because the taxpayer was under age of 59 and a half, and no exception were argued. The return itself was filed late in February 2012, and the court sustained the failure to file addition because no reasonable cause was shown. And then there's the civil fraud penalty. The opinion lists classic badges of fraud and stacks them high. Massive underreporting, inconsistent explanations, concealment, lack of cooperation, illegal conduct resulting in conviction and imprisonment, falsified documents, forged signatures, and late filing. The court also returns to the theme of sophistication. This was a long-time fiduciary who held himself out as an expert, ran training programs, and spoke publicly about fiduciary responsibilities. The opinion even notes that when he testified before Congress in 2010, he had already embezzled approximately $800,000. The taxpayer tried to reframe everything as an investment in non-publicly traded company supported by trust receipts that supposedly represented stock ownership and explained away why the banknote and other assets were titled in the acquisition entity's name. The court doesn't just reject it, it says in places no weight on the trust receipts because they were likely falsified, pointing to criminal trial testimony about backdating and to a district court's description that the documents did not pass the smell test. The tax court also highlights the practical problem. During all the frantic communications with business associates, records keepers, and plan participants, the trustee never once mentioned those trust receipts or this supposed structure. So the ending is as grim as the opening. The court sustains the unreported income, sustains the early distribution tax, sustains the late filing addition, and hits the trustee with civil fraud penalty. And here's my closing thought, grounded in the court's narrative. If your retirement plan cash equivalent requires forged letters, fake screenshots, backdated operating agreements, and a rotating cast of explanations about why distributions can be paid, it's not a cash equivalent. It's a plot device. My name is Alex Dvorkin. I'm a certified public accountant in the state of California, and if you like this video, please give it a thumbs up and subscribe to this channel. And I'll see you in the next tax court case review.